what happens to your RRSP, your Registered Retirement Savings Plan, when you retire? A lot of you have no idea. So in this video, I want to break it down, give you a clear explanation so that you know all this money you've saved up over time, how to efficiently draw down on it in retirement. The RRSP, the Registered Retirement Savings Plan, is a savings tool that you use from 18 all the way up to the date of retirement. And for most of you, this will be the #1 retirement investment account you will build up, meaning that when you hit retirement, this is going to be your main nest egg for drawing income. Now, if you're someone that's lucky enough, maybe works for the government, that has a defined benefit pension plan, maybe your RRSP is a little bit less, but you probably still built something up that you need to draw down. So how is an RRSP actually used when you hit retirement? When do you need to draw it out? How much do you need to draw out? We're going to break this down here. So why a RRSP is so popular is as you put money into it while you're working, it creates a tax deduction. So as an example, let's say you make $60,000 a year and you put $5,000 into your RRSP. CRA looks at it as if you've made $55,000. So you take your $60,000, your gross income, minus whatever you put into your RRSP, and that's the net result for income that you have to pay tax on. So that's where it's beneficial. So ideally, as you're working and making more money, you're going to put money in at a higher tax rate. The idea is it grows tax deferred, so that's one of the side benefits of an RRSP. As you put money in there, as it grows investment over time, you're not taxed on it every single year. You're taxed on it later when you pull it out in retirement, which again, hopefully are in a lower tax bracket in retirement, creating a lot of efficiency. You've gotten the tax break at a high tax bracket, it's grown tax deferred, and you pull it at a lower tax bracket. And that's the way it works for 99% of you. Again, there's going to be the odd person that's actually in a higher tax bracket in retirement, but that's not very common. Now, when you hit retirement, your RRSP needs to be converted to a RRIF, a retirement income fund. Now, they're the same thing essentially. You have an RRSP, it builds up over time. When you hit retirement, all you're really doing is changing the name of the account. So if you think, well, I don't want to sell all my investments in an RRSP to move it to a RRIF, a RIF. The reality is you don't need to sell anything. All you're doing is setting up a RRIF account. So let's say your money is sitting at a financial institution, it's under an RRSP. All you have to do is set up a RRIF account, an RRIF account, and everything can just move over as it is. So think of it as an umbrella, right? RRSP is an umbrella, your investments are under there, you set up a RRIF, and you just move the investments under that umbrella. There's no tax consequence to doing it, there's no fees to doing it, it's very simple. So that's the transition as you hit retirement. Now, you can convert your RRSP to a RRIF at any age. There's no rule around that, except for you need to do it by the year you turn 71. So the year you turn 71, you will be forced to convert your RRSP into a RRIF. You need to start drawing it out in the year you turn 72. So year you turn 71, convert it to a RRIF. Year you turn 72, start drawing it out. Now, for most of you, if you want to create some tax efficiency and proper drawdown in retirement, you're going to convert your RRSP to a RRIF much before age 71. Typically, when you retire, you want to convert to a RRIF and start drawing that money out. Now, a couple key points here. First off, you don't have to convert all of your RRSP to a RRIF as long as you're younger than age 71. So for some people, and again, situational here, but you may have, say, $200,000 in a RRIF, but you only want to take $5,000 or $10,000 out. You could set up a RRIF and just transfer that $10,000 to a RRIF and then take it out. Now, why would you do that? Why not just take it out of an RRSP? Well, typically, an RRSP, there's going to be a fee to pull money out. So if you take $10,000 out, there might be a $25 or $50 fee to do that. Also, when you look at the benefits of a RRIF over an RRSP, RRIF income is retirement income, meaning that you can actually income split it. So if you have a spouse or a common law partner, you can take RRIF income and income split. It's a pensionable income as long as you're 65 or older. So once you hit 65, it is worth it to convert your RRSP to RRIF and start drawing it out from that point because you could income split it. Money drawn out of a RRIF, there's not going to be that $25 or $50 fee. So that's another benefit over the RRSP. So as you start drawing money out of your RRSP, convert it to a RRIF, whether it's the whole thing or partially. I would say typically for most of you watching this video, convert the whole thing over to a RRIF. That's what's going to make the most sense. But again, talk to your financial planner to make sure you know what's best for you. Once you've converted your RRSP to RRIF and you start drawing it out for retirement income, there is a minimum amount you need to take out every single year. So that is one requirement. And that's why you may, if you have a really large, we've had some clients come in with $2 or $3 million RRSPs, great problem to have. But if we convert it to a RRIF, they weren't planning to pull the RRIF minimum out that year. They had some other income. So that would be one of the reasons you may not want to convert the whole amount. But again, for the majority of you, convert your RRSP to a RRIF, start drawing it out. Now, every age, there's a different minimum. So at age 65, the minimum is 4%, meaning that you need to take out at least 4% of the account value at the end of last year. So let's say December 31st, the account was worth $200,000 and you're 65 years old, you need to take out $8,000 as a minimum amount. You can take out up to $200,000. There's no maximum amount on a RRIF account, but there is that minimum. So just keep that in mind. And even the minimum amount is taxable income. Anything you pull out of a RRIF account is going to be taxable income. But again, if you create a good retirement drawdown account, tax plan, all of that, typically you're going to be taking out more than the minimum amount out of your RRIF. If you're someone that's just taking the minimum out every single year, you're probably going to hit a bit of a tax issue later in life. And you haven't done very good tax planning. So again, if you're sitting there saying, I've been retired for a few years, I'm just taking out the minimum, stop. It's time to review and actually build a proper retirement plan because you don't have one. So if that's you, reach out to our office, talk to your financial planner, do whatever you need to do. But if you're someone kind of ticking along, taking out the minimum, you have a really bad tax plan most likely. You want to fix that because you're giving way too much money to CRA and you're not putting as much after-tax money in your pocket. But be aware, there is that minimum amount that you need to take out every single year. There's no maximum amount. So as you convert to a RRIF, just remember, age 65, it's 4%. Up to 65, it scales up every year. So at age 55, it's only 2.86%. And at age 75, it's 5.82%. So again, it kind of more and more as you get older. So just be aware of that minimum amount that you need to be taking that out. Now you can take that out monthly, you can take it out in a one lump sum at the beginning, end, or middle of the year. It's very customizable, but as long as you meet that requirement for the calendar year, you are fine. Now, when it comes to withdrawing your RRIF account, again, there's that minimum amount that you need to take. One thing you need to be aware of is there's no withholding tax on that minimum amount. So again, let's go back to our last example. You have a $200,000 RRIF, you're 65, and you need to take out $8,000. If you only take out $8,000 that year, there won't be any withholding tax, meaning that you're going to get the full $8,000, which sounds great, but have you had tax withheld elsewhere? And what happens is you pull out your $8,000, tax time comes, you've had other incomes along the way, and you owe a little bit of tax. So just be aware of how that tax works. So the minimum amount on your RRIF, there's no withholding tax. Above the minimum amount, there's going to be a withholding tax based on the scale. So across Canada, Quebec's a little bit different. We'll link that below. But for most of Canadians, it's going to be from $0 to $5,000. Above the minimum will be a 10% withholding tax. From $5,000 to $15,000 is 20%, and above $15,000 is 30%. So again, just be aware of that. Again, talk to whoever's managing your money or wherever your money is managed to see, look, if I take out $20,000 versus the $8,000, how much withholding tax will there be? And then look at your plan and make sure that you're on track. Again, you want to make sure that your planning lines up with your income draw, that lines up with your withholding tax. There's moving parts here. So that when tax time comes, you know that, I'm going to owe $500 or $1,000, or I'm going to get a bit of a refund. You know what's going on. Again, I never have an issue with owing tax money as long as I know it and I've done tax planning along the way. But you don't want to get sideswiped in retirement with a large tax bill you were not expecting when you could have prevented it, right? Again, there's one thing. Layer one is make sure you do really good tax planning. And then layer two is, okay, you may have to pay a little bit of tax or get a tax refund. And I'll say this, because this is a video around RRSP to RRIF, so for a lot of you, this conversation means we're early in retirement. For the first few years of retirement, tax planning, like withholding taxes and all that, a lot of times is very rigid. So it takes a few years to get used to. Like there might be more withholding tax by default and you can't control it than the amount of tax you actually have to pay. So you're going to get a tax refund that you can then use for the next year, maybe top up TFSA, whatever it is. So again, first few years of tax planning and money movement around taxes can be quite confusing. So don't get too thrown off on it. Again, make sure you have a good plan, make sure you understand it, make sure you have a good team around you working with you on this. But there are some moving parts. Again, withholding tax, it's CRA mandated. You can't always control that. So maybe they're withholding too much tax and you're going to get a big tax refund. It is what it is. The next part to RRIF. So again, we've converted your RRSP to a RRIF. We need to stake out the minimum amount. There's going to be withholding tax on some of it, potentially above that minimum amount. But now, for most of you, your RRIF account is just one of your income sources, right? You have your RRIF. You might have a lira from an old job that converts to a LIF. You have a TFSA. You might have a small pension. You have your CPP, your old age security. For the average Canadian, you have about 5 to 7 income sources in retirement. Some are taxable, some aren't. Some you have to take right away, some you don't. And this is where the tax planning and tax strategy really evolves when you hit retirement. For a lot of you, for most of you, you've been a T4 employee, meaning that you've shown up to work, you get your paycheck, they take off roughly the right amount of taxes, all the other deductions, and you have your net pay. And when you file your taxes, you might owe a few bucks or get a few bucks back, but it's pretty simple. The only way leading to retirement to save taxes would have been an RRSP contribution or a donation. That's your tax planning. But when you hit retirement, because you have a lot of flexibility and option, and there's a lot of tax planning to be done. And so your RRIF account, once you convert to RRIF, again, there's that minimum amount. For most of you, for 99% of you, you want to be taking more than that, more than the minimum amount. How much? It's going to be dependent on how much you have, all your other income sources, how much income needs you have. There's a lot of factors there. But you typically want to take it more than your RRIF minimum, or you're running into that tax problem that I talked about earlier. But again, how does your RRIF kind of tie in with a non-registered account, a TFSA, your CPP, a pension, an old age secured, all of that stuff? It all needs to work together. And if you think of any of your income sources in retirement as a silo, like individual, like a lot of you think of your CPP and you look at what's your break even on CPP. But now you're just looking at CPP in a silo. Same with the RRIF. If you say, well, I'm just going to pull $20,000 out of my RRIF. Well, how does that correlate with everything else you have going on? Like there's more to it than looking at each one as a silo. Again, you could delay your RRSP for a long time and start your CPP early. Is that the right decision? Probably not, but run those numbers with your financial planner to see what it's costing you or to see what the benefit is. Again, you need to run these different options at different times to figure out, like, all of these income sources come down into a funnel to produce an after-tax income in your pocket. And you want that after-tax income to be as big as possible. Again, you've worked really hard to get to retirement. I don't think there's many of you watching this video saying, actually, Adam, like I put in 1 or 2 hard years and the rest it was quite easy and here I am with millions of dollars. That's not happening. You've worked hard, you've grinded away to get to this point. Well, don't you want that hard-earned money to work for you, right? Your RRIF, it's a big piece of it for a lot of you. Understand how it works and how it integrates with everything else. When should you start government benefits? How do you utilize a tax-free savings account? Taxes around all this stuff. There's a lot of moving parts. Make sure you understand how it works. Now, again, if you want to dive deeper into your situation, our team's happy to help. We do financial planning, fee-for-service financial planning. You can learn more about that at parallelwealth.com/planning. Maybe you have a financial planner you can work with, run these numbers. Again, whether it's us or someone else, we just want you to make sure you're not paying CRA more than you need to, that you're creating the best structure possible, and that you understand things along the way. That is my goal for each one of you, so make sure that you work hard to make that happen.